Okay, so the preparation of the cash flow is not different from the normal cash flow that we have been preparing from just a single entity. The classification is still the same. We are going to be having the classification as the operating activities, the investing activities, and we have the financing activities. Okay, so the classification will still be the same. What will come under the operating activities? Operating activities has to do with the day-to-day issues. So the day-to-day issues will come here, like cash sales, cash purchases, payment of expenses, other issues that are relating to the day-to-day operations of the company. So the expenses and then the cash that you'll be receiving from the ordinary business activities of the entity will fall under the operating activities. What will fall under the investing activities? The investing activities will deal with issues with what expansion. So you are going to be buying an asset. You are buying the asset, it means that you want to expand the operations of the company. So if you are buying a machine, it means that you want to produce more of what you are producing. So you want to expand your operations. So those issues that are going to be deal with what investment in capital asset, issues with the company want to expand. So acquisition of a subsidiary will also come under the investment activities. So something that the entity want to undertake and that is going to give them a return, then we say that that will basically fall under the investing activities. So the investing activities, we are going to be having acquisition of assets, we are going to be having acquisition of subsidiaries, we are going to be having disposal of a subsidiary, disposal of non-current assets, and so many other issues. But if you come to the financing activities has to do with where the company gets money to finance its operations. So redemption of loan, maybe the company is paying a loan. We went for the loan to what? To expand our operations. So the loan is now a source of finance. So where do we get our money or the expenses that we made in attempt to get funds for our operations? So where do we get our money from? So the issue of shares will come under the financing activities. The repayment of loan will come under financing activities, and also lease liability. Okay, if you talk about leases, if you are leasing an asset, it means that though you want to expand, so the leases, the lease that you are paying can also be classified, the capital payments can also be classified as financing activities, or you can also classify it as investment activities. There are certain classifications that it will be like, it is at your discretion to classify them. So if you pay dividend to your shareholders, those particular dividend is paid as a result of finances that they are giving to you. So that will be treated as the financing activities. So all those issues will be treated as a financing activities. Okay, so the classification is still the same. But what normally happens is that we don't prepare the cash flow for one entity. We prepare the cash flow for more than one entity. So we call it consolidated statement of cash flow. So the classification is still the same. We have in the operating activities, the investing activities, and the financing activities. And the method that we are going to be using will still be the direct method, and then the indirect method. So the indirect method and the direct method. So the direct method, we just take our cash receipts. We take our cash receipts. So direct method is just like we are preparing our cash book. So the cash flow statement is just like what? The preparation of your cash book. But your preparation of the cash book, what you want to do is that you want to what? Group the items. So maybe you receive cash from your debtors. In the cash book, you just say cash receipt from debtors. Then you just put the money there. You issue shares and you receive money. You just put over there like equity shares. Then you will just put the money there. But if you come to the cash flow, we want to group the items one by one to see, okay, for the year, what are the cash that we have received or we have spent on operating activities? How much do you pay to our creditors? How much do you pay on expenses? And how much do you receive from sales? So we want to group our cash into different activities. But at the end of the day, it's the same as preparation of the cash book. It's the same as how you prepare the cash book. So it's only cash items that will come there. If you sell on credit, it will not go to the cash book. So therefore, credit sales will not come here. Depreciation will not appear in your cash book. Therefore, depreciation will not come here because depreciation is a non-cash item. Provision for doubtful debts will not come in the cash flow or will not come in your cash book. Therefore, it will not appear in the cash flow statement because it's a non-cash item. So if you're using a direct method, what we do is that we just look for our cash that we receive from our customers, the cash purchases or the cash that we have paid to our creditors, we subtract it. The cash expenses that we have made, we also take it from it because we just take all the payments from what? From the receipts relating to operating activities. Then at the end of the day, we take or we have the cash that we have received from the operating activities. Then we come to our financing activities. Did we sell any asset during the year? Then we have the proceeds. How much is the proceeds? Did we acquire any asset during the year? How much was spent? So what is the net amount? That is it. We come to the financing activities. Did we issue any shares during the year? Yes. How much? Did we pay any dividends? The dividend is cash. So we pay cash for the dividend. How much was paid? We also determine that one. Did we redeem any of our loan? If yes, what is the issue? This is the amount. Then we also know the cash flow that we have spent on what? From financing activities. That is all about it. But you have to know that the cash flow statement is just like the cash book that you are preparing in the office. But for this one, we want to group the items that you have in the cash book that you have. The cash book, you just have the debit side and the credit side. So the debit side, you are going to be having cash sales or cash received from the debtors. So you just put it there. You have equity shares, you just put it there. You have proceeds from sale of assets, you just put it there. But in the cash flow statement, we want to what? Group these receipts under the activities that they fall under. So we are not going to be grouping them anyhow, but we put it under headings. That is the only difference. So for the direct method, it's just simple. You take your cash sales or your cash receipt, you net your cash payment from it. You take your cash expenses, maybe you have paid tax, you have paid interest, you have paid wages and salary, you take it from them and know your cash amount that you have received or you have spent from operating activities. You come to your investing activities to you look at the proceeds that you have received from sale of assets. Then any asset that you bought during the year, you also take it from it. Financing activities, the same thing. So the direct method is always simple. So they don't normally examine the direct method. They examine the indirect method. And the indirect method, what we do is that we prepare our profit or loss statements. So our profit or loss statement is prepared based on both cash basis and also the credit basis. So technically it is prepared based on accrual basis. So if at the end of the day the company is trading on cash basis, it means that the profit that they will be getting at the end of the day will be equivalent to the cash profits. Or if they have depreciation, those are the only items that is going to make it profit. So if the company is selling on credit basis, and at the end of the day, we have a profit of 20,000, it means that this is just like our cash profit because we are not selling on credit. Okay. So what are the non-cash items that we are taking from the cash items before we have our profits? Depreciation will be there, profit on disposal of assets, provision for discounts received, and those ones will always be there. Impairment will always be there. So if you go and add those items back to your profit, then you now have the cash flow because you are selling on cash basis. The only thing that is reducing the cash is the non-cash items. So go and add it back. But what we do is that our profit or loss statements, for the indirect method, we start with profits. The assumption is that there is a cash element in the profit because the sales will be both cash sales and credit sales. So what is the cash element over there? The purchases will also be both credit and what? Cash. What is the element there? Inventory is supposed not to be taken to. If you are doing cash or if you are preparing cash flow statement, the inventory that you are having over there, the inventory has already been captured in the purchases. Whenever you buy inventory, it will be recorded as purchases. So it means that the inventory is already part of the purchases, but we also send the inventory over there. It means that we have to do something about it. So we always start with the net profit before tax, then we just adjust it with the assumption that the profit is having some element of cash because our revenue will be cash and credit. Our expenses, some of them will be cash and some of them will be credit. Our purchases, part of it will be cash, part of it will be credit. So we want to adjust or we want to take the credit items from it and now have our cash items. So we use the profit and we adjust it. For the indirect method, the only part that you are going to be adjusting more is the operating expenses. Why do we adjust it? Why do we adjust it? We adjust it because profit is not cash. Profits contain an element of cash and also an element of what? Credit. Our revenue that we take to the profit or loss statement is the total revenue for the year, which can be on credit basis or on cash basis. So what is the credit element over there? Let's remove it. All right. So what we do is we start with the profit. This is cash flow. We start with the profit after associate profit. So you start with the profit after the associate profits. Then you add your non-cash items to it. Okay. So I'll use example. Then we look at how we go about that particular issue. Let's assume that we have cash receipts or cash from our debtors to be 200,000. Okay. And we have balance brought down, which is the opening balance on the debtors account, to be 20,000. Then we have the closing balance, which is the balance for the year, to be 25,000. Okay. What will be the revenue for the year? What will be the sales that we'll be reporting in the profit or loss accounts? What will be the sales? What will be the sales figure?
155.
The sales will be 155.
Yeah, 155.
Are we sure?
The that's not 20,000, 25,000.
Yes. The opening balance is 20.
Oh, okay. 195.
195, isn't it?
Yeah.
Yeah. So 195 is just like you are owing someone 20,000 and you have given the person 200,000, you are still owing the person 5,000. So how much sales did the person make to you this? Okay. I'm getting 205,000. I'm getting 205,000. Can someone confirm that? Okay. You see, I was owing you 20,000, but this year I have paid you what? 200,000. So it means that I have paid the 20,000 out of that one. So I will settle the balance that I have with you already. So then I will now be having 180,000. So you have sold something. I'm giving you 200,000, to settle the 20,000. So it means that you have sold something to me this year, which is up to the value of 180,000. But I'm still owing you 25,000. So the meaning is that what was the total sales that you have made to me, and I've paid only 180,000, because out of this one I have settled the last balance. So 180 will be for this year, but I'm still owing you 25,000 for this year. So it means that you have sold 205 items to me, and I was able to settle only 180, and I'm still owing you the 205,000. So the revenue that we'll be reporting, for the year will be 205,000. But you can see that this revenue is actually what? Consisting of what? Both cash and what? Credit. So the revenue, you can see that we have made credit sales of what? 25,000, but we are still also including this particular one. But we are only interested in the cash received for the year. So if you go to our cash book, we are going to be having a cash receipt of what? 200,000. That is the figure that we want to put in the cash flow statement. That is the cash that was received. But we are using profit. And the figure that we use to determine the profit, the revenue or the cash receipt, was 205,000. We should have been what? 200,000. So what is happening there? It means that the cash receipt has been what? Overstated by what? By 5,000, isn't it?
Yes.
All right.
Yes.
So what do? We have to go and remove the 5,000 and now bring it to 200,000 like this. Okay. So what we do is that we find a difference. So you can see that this was subtracted. To have 180. But we have added what? 25,000. So it means that we have added what? 5,000 in excess again, because we are subtracting 20,000. So it means that we have to add 20,000 so that we still have our 200,000. But we have added 5,000 in excess. So that particular 5,000 has to be taken away, which we do as the increase in receivables. Okay. I know that you have been singing a particular song that if there is increase in receivables, it means that a company has spent more amount to buy stock. It's a lie. It is the impact of the receivables, is the impact of the closing receivable that will be having on our revenue. We want to show only cash received from the debtors. But in your profit or loss, you are showing what? Revenue, which the revenue can be low or it can be higher. So we want to know what portion of that particular revenue represent the cash, because we want to show only the cash. But the revenue we are showing 205,000, but the actual cash received is what? 200,000. So it means that we have added 5,000 in excess. Where is that 5,000 coming from? It's because of what? The closing balance of the receivables. The opening balance was 200,000. So we have subtracted the opening balance, 20,000. We should have added a 220,000 also to the 180 again to get the cash of 200,000. But we have added 25,000. It means that we have added 5,000 in excess. We have increased our cash received by what? By 5,000. And this was a figure used to determine the profits. So let's remove the what? The credit side of the receivables. That is not representing cash. So that is why we find a difference between the receivables. Then we find a difference between the receivables. If the receivables is increasing, then we go and subtract it. The meaning is that the increase over there has increased our cash sales by that particular amount. So we have to go and bring our sales or our cash sales to the actual value, which is what we have over here. But assuming our cash receipt is 200,000. Assuming our cash receipt is 200,000 and our balance brought down is 25,000, or let's make it 30,000. And our closing balance is 20,000. What will be the sales that we are going to be reporting? What will be the sales that we'll be reporting for the profit or loss?
190.
Okay, so the revenue will be 190. Okay. But in the cash book, what was the cash received that we recorded?
200.
It's 200,000. But you see that since we are using profit for the indirect method, is the cash received in the profit over here is only 190,000. Do we agree? Because we are using a revenue of 190. Okay, so the meaning is that we have understated our cash received by 10,000. Where is that particular thing coming from? You can see that we added 20,000 to this one, and we are subtracting what? The 30,000. So you can see that the opening balance now is reducing the cash received by 10,000 because we added 20,000 to the 200,000 and we subtracted what? 30,000. We have subtracted 10,000 in excess. What is bringing that particular 10,000 as a reduction is the opening balance. The opening balance is going to reduce the cash received more than it should be what? It should be reduced because closing balance is 20,000. The opening balance should also be 20,000 so that at the end of the day, we have our revenue to be the same as the cash receipts. But now our opening balance is higher. It means that the opening balance will be subtracted and we add the 20,000 back to it. You see that we are reducing our cash receipt by 10,000. Okay, so this particular figure over here, we can determine the 10,000 excess by comparing our opening balance and also our closing balance. So the 10,000 now is this particular one. So the question is, what is the impact of the 30,000 on the cash receipt? It's going to reduce the cash receipt by 10,000 because it is higher than the amount that we are adding. So what we do now is that we go and add the 10,000 back to our profits. And people will be telling you that it means that the company has received 10,000 during the year. Cash is coming in. It's a lie. The reduction over here is the effect of the opening balance on the cash receipts. It is reducing the cash receipt by 10,000. So let's go and neutralize that particular effect by increasing our 90,000 to 200,000. So people will be telling you that it means that a company has received some part of the receivables we are settled during the year. It's a lie. It's a big lie. It means that a company has spent more on receivable. It's a lie. It is the effect of the closing balance and then the opening balance on our cash receipts because we are using revenue. The revenue that we should have used should have been cash revenue, but we use credit revenue. So what should be the cash revenue itself is the actual 200,000 that we have. So how do we get the 200,000 back? The closing stock might be having effect on it. What is the effect? Is it increasing it or reducing it? If it is reducing it, then we have to go and add. If it is increasing it, we have to go and what? And subtract. So you can see that the opening stock over here, the opening balance over here is reducing our cash receipt by 10,000. So what do? Let's go and add to make it 200,000 now. Our closing stock over here is increasing our cash receipt, which is 200,000 to 205,000. So what is the effect? It is increasing it. Let's go and subtract it to have the 200,000. That is the issue. That's what we do. And that is the same thing applied to what? To the payables. It's not that the company is borrowing more, so they are saving cash. No. All right. Let's take illustration on payables too. Okay, so let's have the cash paid. The cash paid to be 50,000. Okay, let's have opening balance to be 15,000. Let's have our closing balance to be 17,000. What will be the purchases that we are going to be reporting for the year?
$62,000.
62,000, isn't it?
52.
52, all right. Okay, 52,000, isn't it? Okay, so this is the figure that we have used to get a profit. But what should have been the actual figure for the purchases? We have to use cash. What should have been the actual figure?
35.
Now the cash paid for the year. What should have been the actual figure? What should have been the actual cash spent for this year?
50.
Okay,
50,000.
it should have been 50,000, isn't it?
Yeah.
But how much did we use? How much did we subtract from our cash receipt?
52,000.
We subtracted 52,000. We have subtracted how much in excess?
2,000. 2,000.
So what do we do to the profits now?
We have reduced profit by 2,000.
So how do we adjust it?
We add back.
We add a 2,000 back, isn't it? Okay.
Yes.
How can we get a 2,000? We can get a 2,000 by finding the difference between what? Our opening and closing balance. You can see that we have subtracted 15, but we are adding 17 to it. We are adding 2,000 in excess. So that particular 2,000 is going to be increasing the cash receipts, the cash paid. But the cash paid should have been 50,000, but we are now making it 52,000. It means that we have increased the cash paid and reduced it from cash receipt. We have reduced 2,000 in excess. Let's go and add a 2,000. And that is why if there is an increase in the what? If there is an increase in the receivable, in the payables, we add back. We add. If there is increase in the payables, we add. If there is increase in the payables, we add. So you can see that there is an increase in the payables of what? Of 2,000. The question is, what is the impact of this 2,000 on our cash receipt? It has reduced our cash receipt by what? 2,000, because instead of us subtracting 50,000, we subtracted 52,000. So let's go and make it now 50,000 by adding the 2,000 back. It's not because the company is borrowing more, so they are saving cash. No, that is not the issue. It is the impact of that particular figure on the what? On the cash receipts, or on the cash purchases, or on the cash paid. If your closing balance is now 20,000, your closing balance is 15,000. What will be the cash? What will be the purchases for the year?
$45,000.
Okay, our purchases for the year will be 45,000. But what should have been the cash paid? We are doing cash flow statement. What should have been the figure that we are going to be taking as the cash paid to the creditors?
50,000.
It should have been 50,000. But how much did we use?
45,000.
45,000. So it means that we have subtracted what?
5,000.
We have underestimated our cash paid by 5,000. So what do? We have to go and add a 5,000, isn't it? Okay. So how do we get a 5,000? The 5,000 will be the difference between the opening balance and then the closing balance. Why are we saying that it will be the opening balance? The opening balance should have been 15,000, so that if we subtract and add, we are still going to be having a cash paid of what? 50,000. There will not be any reduction or increase in the cash paid. But we are now subtracting 20,000 and adding 15,000. It means that we are subtracting 5,000 in excess. So if the opening balance of the payables is higher, what is the impact of it on the cash paid? It will surely reduce the cash paid, because the opening balance will be subtracted before we add the closing balance. So if the opening balance is higher than the closing balance, it will automatically reduce our cash paid. So we find the difference over here. The difference will be 5,000. So this 5,000 has reduced our cash paid by 5,000. Let's go and add it back. That is why if the opening balance of the payables is higher than the closing balance, we go and add. And people will be saying that the company has paid part of their payables. It's a lie. It's a lie. It's the impact of that on our cash paid. It has reduced our cash paid. So let's now gross the cash paid, because we are using profits. I will come to the issue of stock. Stock should not be taken from the cash receipts in the first place, because we have already captured the stock in the in the purchases. So let's use the same figures now. Let's use the same figures. So let's assume that our cash receipt is 200,000. So if you are preparing the cash flow statement, we should have cash receipts of 200,000. Then we subtract the cash paid of 50,000. So our actual net cash would have been 150,000. But let's assume that we have used, that should be the actual cash. So let's assume that we have used this particular one, which will be 25,000. So we have a revenue of 25,000. So let's assume that we are doing profit or loss. Revenue will be 25,000. Okay. Then our purchases, let's use the old figure, which will be 52,000. So let's use purchases of 52,000. Okay, let's get a figure for opening and closing stock. So opening stock, let's assume that opening stock is 20,000 and the closing stock is 25,000. Okay, so revenue, then we now have cost of sales. So we have cost of sales. Then we have the opening stock of 20,000. Then we have purchases of 52,000. Then we have closing stock of 25,000. What will be the figure that we'll be having?
7.
It will be 47.
Yeah, 47.
Okay. So let's find our profits. Okay. But the actual cash should have been what?
158.
Okay, 158. Okay. But the actual cash should have been what? 150,000. The actual cash that we are going to be receiving from the operating activities should be the cash receipt minus the cash paid, which should have been 150,000. But we are now having 158,000 as the profit. How do we take this particular issue to this particular place? Let's come here. Did we have anything like stock over here? Did we have anything like stock over here?
No.
No. Okay. But what was the figure of the stock added to this particular figure?
20,000.
Okay. But what was the stock subtracted?
25,000.
Okay. But if we should subtract 20,000, it means that the stock is going to have a zero effect on the cash, on the purchases,
Yeah.
isn't it? Okay.
Yeah.
But what is the impact of the 5,000 now on the what? On the purchases figure over here?
It reduced it.
It reduced it, isn't it? Okay.
Yes.
So it means that the purchases that we should have subtracted should have been 52,000, but we have subtracted only 47,000, which is going to make our profit higher.
Yeah.
So what we do is that we come and adjust the 5,000 against this as a reduction. How do we get a 5,000? It is the 25,000 against the what? The 20,000. What is the impact of the higher closing stock on the profits? It is going to increase the profit, but stock should not be taken to cash flow statement in the first place. It should not be taken to the cash book, but it has reduced our cash by 5,000, which is the cash profit. It has increased our cash profit by 5,000. What do? We go and what? Subtract it over here. So we have to adjust this one by looking at increase in stock, which is the closing stock reducing our purchases by 5,000. So we have to go, if it is increasing, this should have been 52,000. So that if we subtract, we get a figure which will be 153,000. But we are subtracting the 5,000, it is reducing it. So we go and what? We go and take the effect from that particular one by subtracting. Okay, let's now come to another issue. The cash received that we should have used is what? 200,000. But we have used what? 205,000. The meaning is that we have increased our cash received by 5,000, which is the increase in the closing balance. So we come here and also subtract 5,000. Okay, let's come to the purchases. The purchases we are using, so let me make this one to be, so one will be 17,000, one will be 17,000, and one will be 15,000. Okay, so the cash paid, which should have been purchases, we should have subtracted 50,000, but we are now subtracting 52,000. It means that that particular value has increased by what? By 2,000. And what will be the impact on the profit? It is going to be reducing the profit. So what we do is that the 52,000 has been subtracted before we got this figure. Then let's go and add it back to neutralize the what? The 5,000 we have subtracted in excess. Let's now add this figure and see whether we are going to be getting 150,000 or not.
Confirmed.
Yes. So this is how we adjust it. The actual figure we should have used is these figures, but we have increased them, so we just neutralize the increase. So the increase, you ask yourself, you see the opening balance and the closing balance, you ask yourself, what is the effect of the closing balance? If the receivables is high, the receivables will always increase the what? The revenue, because the closing balance will be added to the figure that we are getting. So it will increase it. So you have to reduce it. So increase in receivables will be subtracted, but decrease in receivables will be added, because the decrease will be having a higher effect on the closing balance. Increase in payables will be added, because you can see that the 17,000 over here is having higher effect than the 15,000. So it is going to be increasing the what? The cash paid. You have to reduce it. But a decrease in payables will always reduce the increase in the opening balance will always reduce the cash paid. So what you have to do is that it means that you have subtracted less than you should subtract. So you go and less. The inventory should not be part of the calculation at all, but we include it. So what is the effect of the inventory? If the opening balance is 20,000, the closing balance is 25,000, it means that we have subtracted 5,000 from the cash paid, because 20 against 25,000, the effect will now be 5,000. So we are subtracting 5,000 more from the cash paid. So if you are subtracting more from the cash paid, it means that the cash paid will be reducing, which is going to be technically increasing our cash receipt. So go and subtract. So that is the adjustment. So don't be there and be saying that the company has paid part of their payables. That is why we are adding or we are subtracting, or the company has received part of, or they have sold some of the inventories. No, it is the impact of those ones on the profits. It is the impact of them on the cash items in the profits. Okay, so that is how we go about it. Apart from this one, this is where the working is. We just add the non-cash items, depreciation, impairment, and those things will be added back. Okay. The interest and the interest payments. Okay, you can decide to treat the interest payment as part of financing activities, because you are going to be paying the interest on loan. But if you're preparing a cash flow statement for console cash flow, how do we start? The operating activities, we start with profits after share of associate profits. Okay, profits after the share of associate profit. We start with that particular one. Then what we do is that we add back non-cash items, because those things have been subtracted from the cash. We add back non-cash items. So non-cash items will be impairment, depreciation. The profit from the associate itself is a non-cash item, because that is the profit. We can only recognize the dividend received from them as the cash item. So the profits or share of profit from associate will be added back. The interest will be added back, because the actual interest that we are calculating might be effective interest. So what is the coupon that we are paying? We have to also calculate that and come and subtract. So we add the interest back, we add impairments, we add all those non-cash items. Then after adding that, you come to the working capital items. So the working capital items is the one that we have look at right now. So the working capital items is the things that we have explained right now. So we look at what is the impact of the receivables on our cash receipts. Is it increasing or reducing? We adjust it. So the increase in receivables, decrease in payables, and all those things will come here. Okay, so they will come here and we adjust them. Then after this one, we subtract the tax that we paid and also the interest that we paid. If you are adjusting for the cash, you have to add the fair tax to it, or you can subtract. So I will do the workings and we look at it. For the financing activities, we just look at what is the amount that we have realized from sale of assets. Did we acquire a subsidiary? If we acquired a subsidiary, what is the cash that we paid and what is the cash that we are receiving from them? So the cash that we are receiving from them, we subtract it from the cash that we are paying. Do we receive any dividend from the associate? That will also come there. Do we receive any grant from the government in terms for an asset? If it's a capital grant, what is the portion that we have received for this particular year? It will come there. But if it is a revenue grant, what is the grant receipt? It will also come here. Do we have any lease as a result of assets? What is the issue? We bring that particular, we do the amount that we have paid for the year, the rentals that we have paid for the year. We bring it over here. If you go to financing activities, what do we do? This is how we go about it. So if you are doing the cash flow statement, the cash flow statement is always about reconciliation. They will give you items. They will give you the opening stock. They will give you the closing stock. How do you know the cash that you have paid for the year and the impact on these particular items? So you sometimes they will give you the depreciation because you can't calculate depreciation on your own unless they provide you with all the information that you need. So they will give you the depreciation, then you have to adjust the PPE. Okay, so you have to adjust the PPE. How do you adjust the PPE? The company might purchase a subsidiary during the year. If they purchase a subsidiary, it means that the subsidiary assets and liabilities will be added to that of the parent firm. So you start with the balance drawdown of the PPE, that will be the parent own. Then you ask yourself, the parent acquiring subsidiary during the year? If yes, then the acquisition will increase our PPE. So you add it because they are going to consolidate the two items. The statement that will be given to you means that they have done everything already. So you just have to ask yourself, how did they get these figures? Then you see whether there is something happening there or not. So you add acquisition. It can also happen that the parent has sold part of what, or has sold a subsidiary and they have lost control during the year. So if they are selling the subsidiary and they have lost control, it means that the subsidiary items will not be consolidated for this particular year. But that particular asset might be in the asset at the beginning. So that disposal will also reduce the item. Is there any revaluation surplus during the year? The revaluation surplus will also increase the item at the year. Do you have any disposal of the assets? Do you have any disposal of the assets? What is the carrying value? The carrying value is included in the opening balance. So since we have disposed it, it must be taken away. So we take it off over here. Do we have any other issues relating to the assets? Then we now compare with, this is how the closing balance for the PPE should have been gotten. We have our opening balance, we add the asset that we have acquired from that particular subsidiary, which was added, we add it. Do we dispose any subsidiary with their assets? What is the value of the asset disposed? We take it. Is there any revaluation relating to the assets? We have taken it. Is there any depreciation? Depreciation will be charged on the opening balance. So depreciation over here, depreciation is going to be reducing this particular value. Okay, so what will now be the opening balance? What's supposed to be the opening balance? So the closing balance. Then we have the supposed closing balance. But what is the actual balance reported? So this can be 50,000 and the closing balance that is reported can be 55,000. This shows that the company has acquired additional asset of 5,000. So this is how we adjust it. If you come to the working capital items, so this is how we do the workings for all of them. So the working capital items. So the working capital items, mostly me, I do it like this. We don't include the cash. Okay, because the cash will be shown at the end of the year. So what I always do is that I have my inventory here. I put them together. So I have inventory, I have receivables, and maybe I have payables. Okay, the payables should always be on the what? On inventory. The company might purchase what? A non-current asset on credit, and that will be included in the payables. You have to take that one out because the payables that we are talking about over here is relating to trade payables only for the stock. So sometimes the question can say the company has acquired an asset on credit and the amount has been included in the what? In the payables. It means that that particular payables over there is relating to the asset, not the inventory. So you have to know how you are going to adjust that particular one. So I'll have the currency sign here. I'll have the currency sign here. I'll have the currency sign here. So what I'll do is that what is their opening balance at the end, at the beginning of the year? So the opening balance will be here. The opening balance will be here. Were there any acquisition of the subsidiary that is giving the parent control for the year? So that particular thing will also be added to the parent opening balance. So the acquisition will always be done during the year. So you have to go and add it. Okay. Then you ask yourself, is there any disposal of a subsidiary which their asset has been disposed and the parent has lost control? If the parents still have control, the disposal will not do anything because they will still be consolidating. But if the parents lost control, it means that they will not the asset of that particular subsidiary will not be part of the closing balance. We are just looking for how the closing balance was calculated. This is how they have calculated the closing balance. They take the opening balance, they add the new acquisition, they subtract the disposal of the subsidiary with its associated assets, and they have gotten the closing balance. So this will now be subtracted. This will now be subtracted. Okay. Then we now have the supposed closing balance. So this will give you the supposed closing balance. Okay. And so what is the actual figures reported? So the actual balance is reported in the statement of financial position. So this must be 50,000 and this must be 55,000. Okay. So it means that there is an increase of 5,000. What is the impact of that particular 5,000 on our cash receipts? It has reduced our cash receipts. So we go and add, we go and subtract rather because the cash receipts are reduced by 5,000. So our cash purchases was less. So we go and what? Subtract the 5,000 excess over here. Then you have your receivables. The receivable can be 70,000 and this can be 65,000. Okay. What will be the impact of the receivables of 70,000 against the closing balance of 65,000? There is a difference of what? 5,000, which is less. So the question now is, what will be the impact of that particular 5,000 on our cash receipts? The 7,000 will be subtracted from cash receipts and 65,000 will be added. It means that we are subtracting 5,000 in excess. It is reducing our cash receipt. We go and add. Then you count the payables too. What is happening there? You determine that one till you go. Okay, so this is how we do for the working capital items. If you want to calculate your interest too, okay, our interest paid, you take, so sometimes you can consolidate the interest together with the loan. Maybe they might be using the amortized cost method, or they might be using financial instruments, which is the amortized cost for the loan. So you can adjust the interest together with the loan. That is also another way of doing it. So you ask yourself, what is the balance? How much are you owing the person at the beginning? So maybe this is the figure. And what is the interest charge for the year? How much is the interest again? So you determine that. So what's supposed to be the actual interest? So the supposed actual interest is this one. And what is the interest reported? So this must be 55,000, or this might be 50,000, and the closing balance you'll be seeing will be 30,000. It means that they have paid 20,000 for the year, and that will be the interest paid. If you are looking at the tax to the workings for the tax. If you want to do the tax paid, you take your opening balance. The opening balance should be including the normal tax and the deferred tax. So tax plus the deferred tax, because the deferred tax will be adjusted against the normal tax. So what is the figure there? You put it over here. What is the income tax for the year? Okay, the income tax for a year to be including the deferred tax too. What is for the year? So what's supposed to be the actual tax that I'll pay? The supposed tax that I'll be paying. Then you come to the closing balance again. What is the closing balance? It will be the normal tax plus the deferred tax again. Okay, then you compare the two. So this might be 20,000 and this might be 30,000. It means that you have paid a tax of 10,000. This will be the income tax paid. Then you also come to your return earnings. You also adjust the return earnings. Why are you adjusting the return earnings? We want to see whether the parent has paid any dividend during the year. So we want to know the dividend payment. You also what reconcile the loan or the preference shares or the equity shares to know whether there is any buying back of the shares or there is what issue of new shares. You also have to consolidate your goodwill, or you have to reconcile your goodwill to see whether there is any impairment on the goodwill. You can also reconcile your investment in associates. You can also reconcile your investment in associates to also know if there's any dividend that they have paid or the associates has paid any dividend for the year. Yeah, Sinanik.
So the goodwill, where does it go to? Operating investment or
Yeah, the goodwill impairment will go to operating.
operating?
Yes, please, because it has been charged
Oh.
against the administrative expenses.
All right.
So the impairment of the goodwill. So the question will be giving you, maybe you can be given a question where they are going to be having acquisition of a subsidiary or they will be disposing a subsidiary. So you just have to look at how the treatment will go. It's very important. They can also give you a list. How do you reconcile the list? You look at the lease liability at the beginning of the year. What is the finance cost charge? Then what should have been the actual balance, actual owings? What is the amount that they have now? It means that you have paid this amount relating to the lease. That's how we go about it. So we just reconcile everything over there to get the items. So let's look at a question. Then we know what we are talking about. Okay, let's look at question 2 and question 3. Then we see whether we can solve a question that will be having disposal in it. If you have a question that they have a disposal. Okay, there's a question that we have a disposal here. So let's see whether we can deal with 2 questions. Then or even we can use one to explain a lot of the things, and we use the remaining minute to do foreign subsidiary. We talk about a foreign subsidiary. Okay, let's take the question 3.
The statement of financial position of FB Group as at 31 December 2020 and its comparative are shown below. Okay, Sina, scroll down for me.
Okay. Okay, you want to forget about, okay. Okay, so this one, after seeing the question like this, what will be the first thing that you do?
You put up your structure.
Okay, so
Cash
let's
flow
put,
statement structure.
okay, so let's put a structure there. So what are we starting with?
Operating expenses. Operating activities.
Okay. And what will be the first item that will come under the operating activities?
That's profit from associate.
Okay. That it will be profit after the share of the associate profits. Okay.
Oh, okay.
So we have the FB group consolidated cash flow statements for the year ended. Okay, you can put those things there. Then we have the profits before tax, or you can also say profit before tax, but it should be after the share of associate profits. Okay, so let's go to the question and pick that figure there. So what is the profit? Okay, so that would be, would that be 9,200? Would it be
Yes.
1,200? Okay, 9,200. So the 9,200. Then we add back the interest. The finance cost will be added back. Okay, so what is the finance cost in the question there?
$1,000.
1,009.
Okay, so we have 1,900. So we do the workings over there for them. So 1,900 will be added back. The share of the profit from the associates. The share of the profit from the associates. Is it cash?
No.
No, but you can see that it is part of the 9,200. You can see the
Yes.
share of the associate profit is part of the 9,200. So what do we do?
We less.
Okay, so you have share of the associate profits. Okay, that will be 2,900. We subtract. Then we go and look for depreciation and impairment and all those things. So you come down. The administrative expenses, the only thing that will be non-cash about them is the depreciation and other issues. Okay, so let's go and read down. The question will always give you the depreciation. Okay, depreciation charge in arriving at profit before tax was what?
4 million.
Okay, that will be 4,000. Okay, and then we are no disposal. So let's come to this place. We have depreciation of 4,000. Okay, let's now go and see whether we have any other issues with impairments and anything. Okay, so we have FB acquired a controlling interest in SM. So we have the depreciation over here. So we can leave, you can leave a space like maybe 6 or 7 or 8. It depends. You don't have to. So you can leave a space for other items. Then you can just come to investing activities here. Okay, so you can come to the investing activities here. Okay, so the investing activities, then let's take the B.
FB acquired a non-controlling interest in SM during the year for 6,350. The consideration consisted of 350 in cash and the transfer of 4,000 of FB equity shares with a deemed value of 1.5 per share at the acquisition date. The non-controlling interest was measured at its fair value of 450 at the acquisition date. FB made no other purchase or sales of investment in the year and had no investment at the start of the year.
Okay, so how much is the cash that they are paying for these particular investments?
350.
350. What is the cash that they will be receiving from the subsidiary? What is the cash that they will be receiving? What is the cash in terms of the assets? What will be the cash for the subsidiary?
200.
4,400.
That will be 200, isn't it?
Yeah.
Okay, so they will be spending 350 and they will be getting what, 200? What will be the net spending?
150.
150.
150.
So what you do is that acquisition is a form of investment, but acquisition you net the amount that the cash that you'll be receiving or the cash that you'll be getting from the acquisition from the amount that you are spending. So we have the 350 minus what? 250. Even disposal, the amount that you are selling it, you net the cash that will be going out from it. Okay. So our investment now over here will be the net investment. Okay, it will be 200. So the net investment will be 150 over here. So we are done with that particular side. We need to do another thing over here.
Hello, line up.
Yeah, senior.
Yes, senior, please, what is that 250?
No, it is 200. Are you talking about the 350?
Yeah, the 350 is in the question, but
Yes.
the 250.
Now it's
So
200.
when-
The 200 is the cash. If they acquire a subsidiary, they will be having this asset from them. So it means that this 200 will be added to the cash of the what? Of the parents now. So this is the asset. This is the items that they will be receiving from them. So they are paying the 6,350 for this asset. And out of this asset, we are having a cash of 200. So you are paying 350 cash and you are receiving a cash of 200. So what is the net cash? What is the net amount that you are spending? So we just find that particular one and put it there.
Okay.
All right. So the first thing that you have to do is that calculate goodwill on the acquisition. So let's come to the question.
Senior, sorry,
Yeah, boss.
please, is it the operating activities that we left the space, or we are just starting with the investment activities?
We left space for them. So you can see that the operating activities, we haven't done all of them. There's other issues that will come there. So let's just do the one that we have the information on right now and leave space for them. Okay. So you can't go to the, you are doing this one, you are not in your office and you are doing it in your office, no. So you can't say you want to finish with all the operating activities before you move on to financing activities. So you can just leave a space, like you start with the operating activities. Some of them that you don't have information to right now, you can leave a space for them. Then you now start with your investing activities if you have information about it. Then you can also start with your financing activities if you have information about it.
Okay, thank you very much.
Okay, now. So let's start with the workings, and we are going to be having goodwill. So let's do first. First calculation will be the goodwill. Let's determine whether there will be a goodwill from the acquisition. So the goodwill, we are having a purchase consideration of what? How much are they paying? 6,350. Am I correct?
6,350. Yeah.
Okay. NCA is what? Okay, NCA is 450.
450.
Okay. So NCA is 450. The total will give us what? 6,800. Am I correct? Okay.
Yes.
What is the net asset at acquisition?
4,400.
Okay. So the question will not give you, they will not, cash flow there, they will not give you the net asset as one figure. They will give you the asset and liabilities. Then you have to find your net asset by subtracting your liability from your total asset. So that will be 4,400. What will be the goodwill?
2,400.
Okay, 2,400. So your reconciliation of the goodwill will start from here. Okay, you ask yourself, this acquisition was done during the year. Okay, that is the current year. You ask yourself, was there any goodwill from the, so the current year now is what? The current year now is
2020.
2020. Okay, the current year is 2020. So you can see that there was no goodwill from the previous year, isn't it?
Yes.
Okay, there was no goodwill from the previous year. Okay, there was no goodwill from the previous year, but the goodwill that we are getting now hey, I'm coming now. Let's look at the figures for okay, 6350 and 6350 plus 450 minus 4,500. The goodwill figure in that particular place is not supposed not to be 120. Okay, let's look at this figure. Okay, we are keeping 3 zeros, isn't it?
Yes.
If we are keeping 3 zeros, it means that the goodwill over here, if nothing has happened, it should have been 2,400 if nothing has happened. If nothing has happened, the goodwill should have been 2,400. So how come we are having, how come, let me check. Maybe I've done, I've, the goodwill figure that I've included over there is wrong. So we are having 6350. That is the purchase consideration plus the 450. That will give us 6,800. Then we subtract this one. We'll be having 4,400. So where is the, so where is the old goodwill coming from? So the goodwill figures are supposed not to be higher than this particular figure. Or there should be goodwill at
So there's also impairment on goodwill or something.
yeah, there should be impairment on goodwill. So the goodwill is 2,000. So let's make it 2,000. Okay. So the goodwill is 2,000. But the goodwill that we have calculated is what?
2,400.
So what is if nothing has happened to the goodwill is supposed to be 2,400, but they are now putting 2,000 over there. Okay, they are now putting 2,000 over there. So that means that the goodwill has impaired by how much?
400.
Okay, so there will be impairment of the goodwill by 400. Let me change. Let me edit it. Let me edit it to make it there. 400. Okay. So we now have the correct one. So let's move on. Okay, so let's go to operating activities. Then we have impairment of goodwill. Impairment of goodwill. So the impairment of goodwill will be 2,400 minus 2,000. Okay, what are we going to be doing? Are we adding or we are subtracting?
We are adding.
We add.
So we add 400. Okay, so we are now done with the goodwill. So the next thing that we have to do is to what? Reconcile the asset that we are receiving. So the asset that we are receiving will be added to the parent asset. So the property, plant, and equipment will increase by 2,400. Inventories will increase by 3,600. Receivables will increase by 2,000. Cash, we have already done the cash already, so we just leave it because we have taken it. Their payables will increase by the 3,800. So what we do is let's go and reconcile those items for them. So let's come to the workings 2. We have the PP over here. We have the inventory. We have the receivables. Then we have the payables. So we have the inventory, the receivables. Then we have the payables. Okay, then you put the this thing over here. This thing over here. What you have to know is that the cash flow, they have done the writing already. So you are just coming to do or just coming to demonstrate how the writing has been done and what are the things that relating to cash that was done during the year. So you just want to know the cash movement during the year. So how would the PP for this particular year be calculated? How did they get the closing balance over there for 2020? They have taken the opening balance. They have taken the opening balance and they have added the one that they have acquired from the subsidiary, and they have taken the depreciation from it and they have gotten a figure. So we are doing this for 2020. So the opening balance will be what? Will be the 2019. So PP is 3,200. So 32,000 rather. Then we go to the inventory. What will be the inventory for the year? The inventory for them was 26,000. The inventory was 26,000. Okay, inventory was 26,000. So we look at the receivables, 25,000. Okay, receivables was 25,000. What will be their payables? What was the payables? Okay, let's come to the payables here. The payables is what? Okay, 14,000. We don't have any income tax from them. So we have the payables is 14,000. So we bring the 14,000 over here. Okay, these were the balances for the parent at the beginning of the year before they have acquired a subsidiary. So right now they have acquired a subsidiary, it means that they are going to be consolidating. So they will be adding the subsidiary figures to their own figures. So we are going to be having acquisition here. So the acquisition, what is the PP that they are? What is the PP for the subsidiary? What is the
2,000.
Okay, 2,400. Okay, 2,400. Their inventory is what?
3,600.
Okay, their receivables is
2,000.
okay, and their payables
3,800.
3,800. Okay, so were there any disposals of a subsidiary during the year? No, but you can see that we are going to be having a depreciation on the PP, isn't it? So the depreciation on the PP was given to us, and I'm sure that was 4,000. So depreciation of the PP will be taken. So 4,000. Okay, this will be dash, this will be dash. So let's now look at the supposed closing balance. Then we compare with the actual closing balance that we have. So the supposed closing balance for PP will be what? I'm having 3,400. Is that correct?
Yes.
Okay. 26,000 plus 3,600. That will give us 29,600. I'm having 27,000 and I'm having 17,800. Okay. Then you now go to their financial statement for this year and look at the figures given for the PPE and these items. What is the PPE figure?
38,000.
So 38,000. You now ask yourself. So the figure should have been 400, but it's now
400,
38.
38,000.
So it means that they have acquired additional assets, isn't it? So
Yes.
Okay.
acquisition of assets, acquisition of additional assets will be how much?
7,600.
Okay. So 7,600. Okay. This will be an outflow, isn't it? All right.
Yes.
So you can go to your investment activities and see, okay, acquisition of PPE, acquisition of PPE, and that will be 7,600 outflow. Okay. Then you now go to your inventories. You go to your inventories. Okay. What is the inventory balance now?
28,000.
28,000. Okay. But what should have been the supposed closing balance?
29,600.
Okay. So what is happening now?
A difference of 1,006. So,
Okay, difference of 1,006. It means that the closing
yes.
balance was higher than the opening. The opening balance was higher than the what? The closing balance. Okay. And what would be the effect of this particular figure? What would be the effect of opening balance being higher than the? So we are going to be having a decrease. So this will be increase, or this can be increase or decrease. So the decrease over here will be, so this will be 1,600. Then we now have 28,000. So it means that the closing balance is lower than the what? The opening balance. If the opening balance is higher, what is the effect on the purchases? If closing balance is higher, if the opening balance of a stock is higher, what is the effect on the purchases? If opening balance of a stock is higher, what is the effect on the? Okay, so we have.
It increases cost of sales, so it reduces profit.
Okay, so what do we do? It means that we have to come and add it back.
Yeah,
Okay.
we add back.
Okay, so it has reduced our cash receipts. It will increase our cash paid, which is the purchases, and that will reduce our cash receipts. So we go and add it back. So we look at the decrease in inventory. So decrease in inventory, and that will be 1,600. So we add. So we go to the next item. We go to the next item. That will be receivables. The receivables is 27,000. But in the statement of financial position, what is the receivables for this year? What is the receivables? 22,000.
22,000.
Okay. So 22,000 against 27,000. There will be a difference of what? 5,000. And that is going to be 22,000. What will be the effect of a higher opening receivables on the cash receipt? It is going to reduce the cash receipt, isn't it?
Yes.
So what do? We go and add this particular one back. Okay. So we look at the decrease in receivables. Decrease in receivables. So we are subtracting 27 and adding 22. So there will be an increase. There will be an increase of 5,000. So let's go and add. Then let's now come to our payables. Our payables, what is our payables in the? Our payables is what?
20,000.
20,000. Okay. So our payables is 20,000. So payables is 20,000. But the figure over there is 17,800. So what?
Yes. 200.
Okay. So these 200. So it means that the closing balance for the payables is higher than the opening balance. What will be the impact of that on our purchases? If the closing balance is high, it means that the purchases will be increasing, isn't it?
Yeah.
Which is going to be reducing our profits.
Yeah.
So what do we do? It
We
means
add.
that we go and add it back, because that particular will actually be increasing our cash receipts, but the cash receipts should not be up to that particular value. So if our cash paid is increasing, it means our cash receipt will be reducing. So let's go and add that particular one. So increase in the payables. It's not that the company is borrowing more money and they are saving cash. No, it is the impact of this on the cash that you are reporting for the purchases. It will be increasing and it will be reducing the cash receipts. So let's go and have the actual cash receipts. So that will be the changes in the working capital items. Let's now move on to other adjustment that we have to do. Okay, the question will always be, the adjustment will always be about the PPE, the inventory, and those ones. Those are the major workings that you are going to be doing. Let's reconcile. We have reconciled the PPE. We have reconciled the goodwill. Let's reconcile the investment in associates. The investment in associates, we are only looking for the dividend that we have received from the associates. So let's reconcile the investment in associates. Okay, so let's come to workings. Right, we have the investment in associates. Investment in associates. Let's reconcile that. So we start with the opening balance. The balance brought down was 9,000. Okay, how do we account for the investment in associates? We have to add the share of the profits, isn't it? So the parent share of the profits will increase this. So let's go to the share of associate profits. So the share of the associate profit, how much was given to us? The share of the associate profit was how much?
2,900.
Okay, 2,900. Okay, 2,900. What's supposed to be the, what will be the supposed balance?
11,900.
Okay, 11,900. But what is the closing balance there?
11,000.
Okay, so what is happening there? It means that the balance are reduced by what?
900.
Okay, so that 900 can be impairment. Okay, it can be two things. It can be the impairment, or it can be dividend that the parent has received from what? The associates. But if nothing is said, take it as dividends. So it means that the associate has paid a dividend of, so dividends received, dividend of 900. Okay, so this particular dividends will be treated as investment income for the parent and their investing activities. So dividend from the associates, and that will be 900. It will be a cash inflow. So if nothing is being said about the difference being an impairment, take it as dividends. So that is how we reconcile the associate to. The only thing that is going to be having issues with the associate over there is the dividends. The next thing that you have to reconcile is the NCI. You want to know whether the NCI is going to be receiving any dividends, whether the NCI is going to be receiving any dividends. So you start with the NCI. Do they have any NCI at the beginning of the year?
No.
No. So they don't have any NCI at the beginning of the year. So the only NCI that they will be having now, so let's have workings for. So the NCI will just be the NCI from what? From the acquisition. So the fair value supposed to be 450. Am I correct? Okay. Then we have the share of the post-acquisition profits. So let's go to the NCA share of the profits. What is the NCA share of the profits? The question will always give you that.
500.
Okay. So what's supposed to be the balance for the NCI? Supposed to be 950. But the question is, what is the balance for the NCI over here?
650.
Okay. There is a difference of
300.
there's a difference of 300. That 300 will be seen as dividends paid to the NCI by the subsidiary. Okay, so that will be 650. What we have to know is that the NCI is also accounted for as investment in associates. But you don't know. The NCI is having what? Less than 50%. Any investment that is having less than 50% will be seen as having a significant influence, but it is more than 20%. So the NCI, for those who are having the NCI, they will be accounting for the NCI as investment in associates. So any dividend that they are going to be receiving will be reducing the NCI. So the NCI is accounted for as investment in associates. It's accounted for as investment in associates because the percentage holding is more than 20 but less than 50. And that will be giving a significant influence. So we have a dividend paid to the NCI that will be shown as a line item under financing activities. So we have dividend paid to NCI. Dividend paid, and that will be NCI. Dividend paid, that will be 300 under the NCI. So let's now reconcile the tax, the income tax. Let's reconcile the income tax. Then we reconcile the payables already. We reconcile the long-term borrowing. Then we move on to other issues. So let's reconcile the income tax. Okay, the income tax at the beginning of the year, how much are we owing the tax authority?
3,200.
Okay, we are owing them 3,200. Okay, what is the amount that we're supposed to pay them this year based on the profits? What is the tax that we're supposed to pay this year based on the profits?
2,500.
Okay, 2,500. Okay, so we're supposed to pay them 2,500. That will be the charge for the year. Charge for the year. And I said that if you have deferred tax, you add the deferred tax in the calculation. Okay. So we have charge for the year. So what will be the supposed amount that we're supposed to be owing them at the end of the year if we haven't paid them anything? What is the amount that we're supposed to be owing them?
5,700.
Okay, 5,700. But what is the figure that we have in the statement of financial position?
4,000.
Okay, so it means that we have paid how much?
1,700.
Okay, so tax paid will be 1,700. So that we have the 4,000 as the balance. So you come to the operating activities, then you have to add these items. So you have the net cash flow before you bring the income tax paid. So you bring the tax paid over here. You bring the tax paid to be 1,700. Am I correct? Okay. Let's look at the interest paid. So let's reconcile the interest payments. The interest payment, you have to reconcile the interest payment together with what? Together with the long-term borrowing. You assume that the company is using the amortized cost for the loan. Okay, so we start with the value of the loan that we have. Okay, then you ask yourself, because the interest and then the principal will be paid together, unless there is no loan and the question is saying that they are paying the interest separately and they are also paying the loan also separately. Mostly the interest and then the loan, or the interest and then the actual loan will be paid together. But let's see what they are saying about the loan over here. Okay.
Finance costs relate solely to the long-term borrowing. The effective interest rate of 4.524% was charged on the opening balance of the liability, and interest of 1,200 was paid on December 20, together with the capital repayment.
Okay. Let's now come here. Let's first of all, you ask whether we have interest expense over here. Do you have interest expense over here? Do you have interest liability?
No.
No.
Okay. So we don't have interest liability. Assuming we have interest liability, we reconcile the interest liability before we go to the loan. But this one, they are saying that they are paying the loan together with what? They are paying the interest together with the principal repayments. So let's now come here. What is our loan at the beginning of the year?
42,000.
Okay. And what was the interest charge on it? They have given us the percentage as the interest charge.
4.5.
Okay, so let's calculate that and see how much we are getting. I'm getting
1,009.
1,900, isn't it?
Yes.
Okay, let's look at the finance cost over here.
1,009.
Okay,
1,000.
okay, the finance cost is 1,900. So they are saying that they have paid the interest together with what? With the capital. And how much was paid? So they are saying that they have paid the interest together with what? With the principal, and that will give you the total amount paid is, okay, they have paid interest of 1,200. Interest of 1,200 was paid together with the capital repayments. But the question now is, the interest paid was 1,200. But what is the portion of the capital that was repaid? The principal that was repaid. We have to find it because the interest is what? Is 1,200. But they haven't given us the total amount that they have paid. The total amount paid will not be 1,200. 1,200 is only for the interest liability. They have paid 1,200 out of 1,900 for the interest. Okay, but they are saying that they have paid a certain amount together with the interest, which will be the capital repayments. Okay, so let's come to how do we know the amount that is paid as the what? The capital. So you reconcile like this. Let's come to the long-term loan. So you reconcile the long-term loan. Okay, so we have the opening balance. The opening balance is what? Is 42,000, isn't it? All right, so they'll add the interest to it. The interest is 1,900. Okay, how much are we going to pay them? What's supposed to be the actual amount that we're supposed to pay them? 4,000.
43,900.
Okay. But what is the closing balance there? What is the closing balance for the long-term loan?
36,000.
Okay. What is the difference?
$7,900.
Okay. So 36,000. So the difference is what? Okay. So this is the payment made. Okay. But this particular payment, interest is 1,200. Interest is 1,200. So what would be the principal payment?
6,700.
6,700. Okay. So they have paid interest. So you just find the total amount paid, then you take your interest portion from it. Or you can also find this one like this. Okay. It means that they have paid interest of 1,200. The interest that will be remaining over here will be 700. So you can add the 700 to 42,000. Then you subtract the 36,000 from it. So 42,000 plus 600 plus 700. Then you take your 36,000 from it. You will be getting the same answer. Okay. Or you just find the total amount, then you take your interest portion from it. So your interest portion. So we come to repayment of loan. Repayment of the loan. Okay, that will be 6,700. Then we go to the interest paid will be 1,200. Okay. Let's now go and reconcile the equity items. Let's reconcile the equity items. So an impairment review conducted at December, this one, we have done that one already. And the D2, we have done the D already. The effective interest rate was charged on the opening balance of the liability, and the interest of 1,200 was paid in December, together with the capital repayment. So we have calculated a capital repayment of 6,700. So we are done with the footnotes. Let's count to the what? To the equity items. Let's count to the equity items. What's the share capital at the beginning of the year?
20,000.
Okay. So let's have the share capital. Let's reconcile the share capital. So we have the share capital. So the balance go down will be 20,000. Okay. What is going to increase the share capital? You can see that they have also settled the conflict through the issue of what? Shares, isn't it?
Shares.
Okay. So you can see that they have given them, instead of them paying cash, they are giving them 4 million shares at 1 cedi. So what will be the value for the shares that they are giving to them?
6 million.
Okay, that will be 6 million. So that will be increasing the shares. So share exchange will come here, which will be 4,000 times 1.6. And that will give us what? 6,000. Okay. We have 6,000. But what is the actual balance there?
35,000.
Okay. You can see that there will be a difference of something there, isn't it? Okay.
Yes.
Don't be too quick to conclude that it is additional issue of shares. It can also be a bonus issue. So you first have to come and reconcile your retained earnings to see whether the difference that you'll be getting from the retained earnings will be the same as the difference between the share capital. If it's the same, then you take it as what? Bonus issue. If they are doing a bonus issue, they will convert the retained earnings or the reserves to what? Equity shares. So don't be too quick to conclude that that is issue of new shares. Go and reconcile your retained earnings and see whether the difference over there is the same as the 6,000 or something, or the 7,000 or the 9,000. Then you know that that is what? The bonus issue. So let's come and reconcile the retained earnings first before we come to the share capital. So let's reconcile the retained earnings of the parent, which is a group retained earnings. Okay. So the group retained earnings, we have the balance brought down to be what? The balance brought down for them is what?
14,300.
Okay, 14,300. What is going to increase it?
Profit.
Okay, so the share of the parent's profits, share of profit will increase it. So what is the share of the profit for the parent there? That will be, you can get that in the statement of profit or loss. 6,200. Okay. Sometimes they can give you other comprehensive income items. If you want to reconcile this particular one, you only bring the parent's share of the profit to retain earnings. Then their share of the comprehensive income will go to either other component of equity. You go and reconcile that side also. So this will be 6,200. So what's supposed to be what will be the supposed balance? Okay, I'm having 2,500. Is that correct?
Confirm.
Okay, but what is the balance that they have here?
18,350.
What is the difference?
2,150.
Okay, is it the same as the balance that we are having on the equity share capital?
No.
No. So since they are not the same, you take the difference from the retained earnings as dividends because they have paid a dividend. So this will be a dividend. So it means that they have paid a dividend of 2150 over here. And that's how they are having 18,350 because the only thing that will reduce the retained earnings is what? Is the dividends. So you come here, then you have issue of new shares. So issue of new shares. And that will give us how much? Because the difference is 35,000.
9,000.
That will give us 9,000. So issue of new shares will be 9,000. So you come to investing activities, financing activities, you have issue of new shares. Will be 9,000. Then you have dividends payment. The dividends paid, which is for the parents, that will be 2150. Okay. So you have to be very careful with the reconciliation of the retained earnings and also the share capital. So the retained earnings is if the difference between the two of them is the same, then you can assume that they are bonus issue, which is not going to be involving cash. So you have to be very careful when you are reconciling them. I'm sure that we have reconciled all the items and there is no item that we have to reconcile again. So let's go and put the figures together and see what we will be getting at the end. Okay, let's come to the financing activities. What are we getting? What is the net spending over there? I'm getting a net spending of 150.
Confirm.
Okay, let's come to investing activities. I'm having a net spending of 6850.
Okay.
Is it confirmed?
Yeah, confirmed. Yeah.
Okay, so let's come to operating activities and see what we are having. I'm having net receipt of 18,500. Confirm.
I'm lost though.
Okay. Do this side first. All of this
18
side.
what?
18,500.
I'm having 18,300.
Okay. We have 1,900. Okay. 1,900 plus 4,400 plus 1,600 minus 2,900. Okay. Then we come here plus 5,000 plus 2,200. Then you subtract 1,700. Then you subtract 1,200. I'm having 9,300 plus 9,200, which is the profit. 18,500. Christina, can you try it again?
Senior,
Yeah.
I beg you, the PP, the
Yes.
increase in the PP, is it 7,600?
Yes, please.
Yes, sir, it's 9,300.
Okay, 9,300. Then you add it to the 9,200, which is this one over here. $18,500.
18,500 confirmed.
Okay. Okay. So
And you go operate.
yeah, the operating. Okay.
Please go to the next. It's okay. It's okay. I'll go through it.
Okay. So let's look at the net cash flow. The net cash flow for the year. So 18,500 minus 6,850 minus 150. I'm having the net cash flow. The net cash flow from all that.
11,500.
Okay. So the net cash flow will be 11,500. Okay. So this is the net cash flow from all the activities that happened during the year. But what will happen? This will be added to the opening balance. So we add this one to the opening balance. So this is the cash that we have for this year. Okay. We haven't touched the opening balance, and that is the cash that we have for this year. So let's go to our opening balance and see. What is the opening balance for the cash?
$1,500.
Okay, 1,005. Okay, the opening balance is 1,005. So if you add, what are we getting?
$13,000.
Okay. And that must give you the cash balance at the end, 13,000. Okay. So that is all about the cash flow. The only thing about the cash flow is the adjustment. The issue that has been added is what you reconciling your non-controlling interest, your PP. The PP you have to add that of the subsidiaries own to it. And the company can also dispose some of the subsidiaries during the year. So let's come to this one. There is a question here that there's a disposal here. So the company acquired this particular company during the year, and they have also disposed a subsidiary. So during the year, they have acquired this particular subsidiary, and during the year, they have also disposed this one. Okay. So if you want to go about this particular issue, what you do is you will take your 2014, you take your 2014 balances. Okay. The 2014 balances, the first subsidiary, this particular subsidiary was acquired during the year, and that will be 2015 because we are looking at the current year, 2015. So you add all these PPE, you add the PPE inventory receivable, cash you don't add, you separate the cash from the cash that they are paying. Okay, the trade payables and the taxation, you add it to their figures, you add it to their liabilities and those ones. But if you come here, you can see that during the year, Shell also dispose of its 60% equity shareholding in Stone for cash proceeds of 850. The subsidiary has been acquired several years ago. Several years ago means that their asset is part of the opening balance for the parents because they have been acquired several years ago. So we have been consolidating them since. So it means that their assets and liabilities are also part of the opening balance. So after adding these subsidiaries on, you have to come and subtract these subsidiaries also, but you don't subtract the cash. The cash will be subtracted from the cash that the company is receiving. So this 50 will be subtracted from the 850 over here. Then there will be a gain on this particular sell because the parent will lose control. So the gain will be taken to profit or loss or something. They will show it or they will tell you that the gain has been taken to that place. What will happen? Since you are disposing these people off, it means that the NCA will also be what? Going off. So they say that the NCA holding was at its fair value of 320 at acquisition, and the fair value of Stone net assets were this. Okay, goodwill have not suffered any impairment of this. At the date of disposal, the net assets of these people were this one. So the NCA over here is at acquisition. How do you find the NCA at disposal? The NCA at disposal will just be the NCA at acquisition plus the what? Post-acquisition profits. How do you find the post-acquisition profits? It will be the net asset at disposal minus what? The net asset at what? At acquisition. Then you find the NCA portion of it and add it. That's how we do it. We go about it. So you have to reconcile the NCI. The one that they are selling, the NCI will be out of the NCI. So you take the opening balance of the NCI, you add the new subsidiaries one, then you subtract the one that they are selling. But you subtract the one at the date of disposal. You subtract at the date of what? The disposal. You subtract the one at the date of disposal. So that is how you go about this particular one. The disposal, there is no big issue over there. There will be a gain on disposal. That particular gain is not a cash item. You have to go and take it from your profits. So let's look at the statement of profit or loss and see whether there is a gain on it over there. Okay, you can see gain or disposal of subsidiary. That will be 100. Gain on disposal of subsidiary is 100. So you start with profit before tax, but the income from associate, gain on disposal, finance costs, all those ones will be what? Will be added or subtracted back from the profit before tax. Then you now come and reconcile one by one. That is it. I want us to talk about foreign subsidiary. Then we know that. All right. Okay, the foreign subsidiary is very simple. It's cash flow and foreign subsidiary are usually the easiest part of the advanced consolidation. They are the easiest part of the advanced consolidation, and that is even the reason why they are not examining them on their own. Okay, that's why they are focusing on the step acquisition, complex goods, and then the disposal. Okay, you see, if you talk about foreign subsidiary, what we do is that a company in Ghana, their presentation currency will be the Ghanaian cedi, and they have now acquired a company in Nigeria. So these two companies will be preparing their what? Their individual financial statements. But at the end of the day, the group has to what? Prepare what? The consolidated what? Financial statement, or have to prepare the financial statement for the group as a whole. How do you go about it? A company is using Naira and a company is using Ghana cedis. How do you combine the two? It means that the Naira company, which is a subsidiary, their currencies must be translated to that of what? The parent what? Currency. So during the consolidation, the parent has to what? Translate all the profit and loss items of the subsidiary to their presentation currency and also their statement of financial position items to their presentation currency as well. So the question now is, which currency are we going to be using for the what? The profit or loss items? Is it that the profit or loss items are prepared for the year? There will be a lot of what? Fluctuations in the exchange rate during the year. So the best one is that we use what? Average rates. The rate can change like what? 3 times in a month. So we use average rate for each month. And at the end of the year, we use what? Average rate to translate what? The profit or loss items. So the profit or loss items are being translated using the average rate for the year. So if the question will give you the rates for each year, that the translation rate, they will give you the average, they will give you the opening balance, they will give you the closing balance. So let's assume that at that particular date, one CD is equal to maybe one CD is equal to maybe 2 Naira. Okay, so the subsidiary is having a revenue of 20,000 Naira. So if one CD is 2 Naira, how many CDs will be 20,000? So we have one CD is equal to 2. How many CDs will be 20,000? So that will be 10,000 CDs. So you just do in the statement of profit or loss, if it is a full year or it's a half year, you just do 6/12 multiplied by 20,000 Naira divided by 2. So you translate it. If it is a 9 months, you do 9/12 times that particular value. You do the translation. Cost of sales, if it is 15,000, you do 15,000 divided by 2. If it is 6 months, you multiply by 6/12. That is how you do for all their profit or loss items. So their inventory will be translated using the same rates. Their cost of sales will be translated using the same rates. Their revenue, their administrative expenses, their tax figure, their finance cost, their distribution cost, their revaluation gain, all of them, profit and loss items will be translated using the average rate. If there is any intra-group trading, the intra-group trading will be treated as the normal way of treating it. Who is selling? If it is the subsidiary that is selling, what figure are they selling at? So this one, what you have over here is that you will do the 2 over this one over this, then you subtract the value of the inventory that they are selling. The value of the inventory that they are selling, because the inventory will be for post-acquisition period. So you can also do the 2,000. You can find 6/12 for the 20,000. The figure that you get, then you maybe 10,000 that you are getting. Then you subtract the post-acquisition sales of what 12,000 before you now translate it. Or you can subtract, or you can do translation over here. Then you now also translate this post-acquisition sales differently before you subtract. Anyhow you want to do it. If there's any impairment and all those things, they'll all be translated using the average rate. So the profit or loss items will be translated using the average rate. For statement of financial position, all the items that will go to statement of financial position will be translated using what? The closing rate. That is the rate at the reporting date. So if you have their PPE, you translate all the PPE using the closing rate. That is the rate at the date of the reporting. You have to translate it. Goodwill will also be translated using the average rate. But what normally happens is that goodwill at the date of acquisition. At the date of acquisition, what normally happens is, at the date of acquisition is, what normally happens is that we are going to be calculating goodwill at the date of acquisition. And the goodwill, if you calculate it at the date of the transaction, it will be translated using the spot rate. That is the rate at the date of what? So we translate the goodwill to that of the what? The parent currency at the spot rate at the date of acquisition. But they are saying that the goodwill should be translated using the closing rate. So let's assume that the goodwill was 30,000 naira and the exchange rate at that date was 3 cedi. So the goodwill in Ghana cedi will be 10,000 Ghana cedis. Okay. That is the goodwill at this date is what? 10,000 Ghana cedis. Assuming the goodwill has not impaired, it means that the date of reporting the goodwill will still be what? 30,000 naira in the foreign currency. But the question is, what is the value of the 30,000 naira at the reporting date? It can happen that at this date, the exchange rate is now 2.5 cedi. So our goodwill at the reporting date will now be 30 naira divided by 2.5. And we are now having 12,000. Okay, this particular 12,000, the goodwill has increased by 2,000. And this particular 2,000 will now be a gain on the translation. How do we share the gain on the goodwill? It depends on how they are valuing the goodwill. If they are using a full goodwill method, it means that the gain of 2,000 will be shared between the NCI and the parent. But if they are using partial goodwill, it means that the gain will only be what? Given to the parents. But how do we treat the retranslation gain? The retranslation gain will be shown as other comprehensive income items. So if the gain is relating to this particular year, we send it over there. But what if the goodwill has impaired? So let's look at the goodwill now. So the goodwill at acquisition, let's assume that the goodwill at acquisition will be, so at acquisition, the goodwill figure at acquisition, the fair value is 30,000 naira. Okay, it's 30,000 naira, which is translated as 10,000 Ghana cedis. Okay, they are now saying that the goodwill has impaired by 3,000 naira. So let's count the impairment over here. So the goodwill has impaired by 3,000 naira. But this particular 3,000 naira will be translated using average rate because the impairment is a profit or loss item. So let's assume that our average rate is 2.5 or our average rate is 2. Okay, it means that this will now be 1,500. So our goodwill at reporting supposed to be 8,500. But in terms of naira, what will be our goodwill at reporting? Our goodwill at reporting should have been a 30,000 naira minus the 3,000 naira. That will give us the naira equivalent. But the question now is, this is now on the what? On the historical amount and then the average amount. But this 27,000 naira over here will be translated using the closing rate. The question now is, what is the closing rate at this date? Maybe 2.5. So 27,000 naira divided by 2.5. You'll be getting 10,800. This is the figure that you'll be taking to your statement of financial position. But this is the goodwill based on your historical rate. 8,500 against this one. There will be a gain of a certain value there. So that will be 2,300. Okay. So this 3,200 over here will be shared among the NCI and the parents if they are using full goodwill method. So the translation will result in a gain or result in a loss based on what is going to happen. The first gain or loss will be on goodwill. The goodwill will be translated using the spot rate. But at the end of the year, the goodwill must be translated using the closing rate because the goodwill is statement of financial position item. How do we calculate the gain on the goodwill? How do we calculate the gain on the goodwill? So the gain on the goodwill, how is it calculated? How is the gain on goodwill calculated? Okay, we look at the goodwill at acquisition, the translation at acquisition, translation at acquisition. Then you take the impairment from it, if there is any, the impairment up to date, and that will be using average rates. You translate the impairment using average rate, then you take it from it. Okay, then you now look at goodwill at reporting. Goodwill at reporting. The goodwill at reporting will be translated using the foreign currency equivalent of the goodwill will be translated using closing rates. So you compare and see which one is higher. It can be a gain or it can be a loss. So the first one is we calculate the gain on a goodwill. Another way of calculating the gain on the goodwill is this one. You can also calculate the goodwill, the gain on goodwill by using, you translate the acquisition figure. You translate the acquisition figure, you use the opening rate, then you still use the closing rate for the same figure. If you come to impairment, you use the average rate, then you still use the closing rate. So you just compare the two over here, compare the two over here, compare the two over here. So if the closing is higher, it means that it's a gain. But if the opening is higher, then it is a loss. You can also do it like this and get the total gain on the goodwill. The gain will be taken to profit, will be taken to other comprehensive income. The another item that we calculate a gain on is the net assets. Okay, you see that the net asset at the date of acquisition will be translated using the what? The acquisition rate, which is the opening rate. It will be translated using the opening rate. But at reporting, the net asset will now be what? Translated using what? Closing rates. So what do? We have net asset at acquisition, net asset at acquisition, which will be translated using the spot rate at acquisition. We have it over here. What is going to increase the net asset to have the net asset at reporting? It will be the profit for the year. The profit for the year of the subsidiary, profit for the year, which will be translated using average rates. So you translate it using average rates, then you add it to this one. That is a supposed net asset. What is the net asset in the subsidiary currency? So we find the net asset at reporting. Then you translate this one using the closing rates. Then you compare. If the closing is higher than that one, then that will go to other comprehensive income as a gain or loss. And this one will be shared among the NCI and the parent because it's arising from the subsidiary. It's only the goodwill that will be restricted to only the parent or this. So these are the workings that you have to do. But if you can't do the workings, you can just translate and move on. If you can't calculate the gain on the goodwill, the gain on the net asset, just translate and move on. We have another way of doing this one, but I don't want to bother you. You can also avoid the gain on the goodwill and these ones, and you move on. You can avoid calculating the gain on the goodwill direct. But if you're using statement, if the question asks you to prepare only statement of financial position, that is when this particular method will work. But if they ask you to prepare statement of profit or loss and statement of financial position, it means that you have to show the gain on the goodwill, the gain on the net assets, the translation gain in the other comprehensive income. So the method I will show you will not work, but it will only work for statement of financial position. What will happen is that for the statement of financial position, you will do the NCI calculation in the foreign currency. So you do the NCI calculation in the foreign currency. Then at the end of the day, you translate the NCI at reporting the closing balance using the closing rate. That will automatically give you the NCI figure if you are using all this method. that will work for only statement of financial position. That will work for only statement of financial position. And if you are doing the parent share of the parent share of the subsidiary profit, what you do is that you also translate it using closing rate straightforward. That is only for statement of financial position. But they are asking you for the two, then you have to show the gain on the goodwill, the translation gain on the goodwill, the translation gain on the net assets separately in the statement of other comprehensive income. Let's pick a question and see whether we can finish solving it. So that is all about this. So let's pick the question 1. Let's see the question 1 if we can finish it before the time. So this one, they will always ask you to do the two. You prepare the statement of profit or loss, at the same time, statement of financial position. Okay, so after seeing the question like this, you just have to determine if the acquisition is a full year or it's half a year or some months. If it's some months, then you just go and do your reconciliation at once. Okay, so what we'll do now is we prepare statement of financial position and we also prepare statement of profit or loss. Okay, so let's look at when the subsidiary was acquired. The acquisition date is what? Hey, it's now Justin, you are not here. It's not Deborah, can you read for us?
Okay.
So
Memo, a public limited.
let's look at the acquisition date. Can you point where the acquisition date is?
Memo acquired random on 1st May 20x3 or 120.
What is the reporting date?
Reporting 31st April 20x4.
So that is 1 year. That is a full year acquisition, isn't it?
Yes.
Okay. So since you identify that as a full year acquisition, you start with your statement of profit or loss, which will be a full year. So you start with the memo will be the parent, memo group. Then we have the consolidated statements of profit or loss. Then you have revenue. Okay, so the revenue, you pick the parent one. Okay, let's assume the parent is in Ghana City. So what is the parent revenue? What's the revenue for the parents?
2 million.
Okay, 2 million. So you go and look for the average weight. The question will give you the average weight. So you go and look for the average weight. So let's go and look for the average weight and see whether we are going to be multiplying or we are going to be dividing. Okay, let's count the rate over here. Okay, you can see that crowns to $1. The average weight is what? 2 cedis, isn't it? It's 2 crowns. The average rate for the year is what? 2 what? Crowns. So it is the quotation is like this. We have crown is equal to $1. So the question now is how many, if we have crowns now, the revenue over there is 142. So how many of these will give us this particular one? It means that we have to be dividing this time, this, and this. So we will be dividing. So you first have to determine whether you are multiplying or you are dividing. So we will be dividing. The retranslation will be division. So let's go and look for their revenue. Their revenue is 142. So that will be 142 divided by 2. So plus 142 divided by 2. Okay, that is the revenue and that is the translation. Okay, 142 divided by 2. So let's come to cost of sales. What is the cost of sales for the parents? What will be the cost of sales for the parents?
So 120.
Okay, for those people it's 96, isn't it? Okay.
Yes.
So we have 120 plus 96 divided by what? 2. Okay, let's come to the gross profit. The gross profit, we don't do anything because if we do the calculation very well, it will come by itself. Okay, the next item is what?
Distribution and administrative expenses.
Okay, distribution. So we have the distribution and admin expenses. For the parents is how much?
30.
It's 30.
Okay, the subsidiary is what?
20 divided by
It's
20
20. 20 by
20
2, which is
divided by
10.
2. Okay, so the next item is what?
Operating profit.
Okay, operating profits. Okay, that one too, we don't do anything because if you do the workings very well, we get the operating profits. So we have the operating profits. Okay, the next one is what?
The next one is investment income.
Okay, the investment income. How much is it for the parents?
It's 4.
Okay, the subsidiary is having none.
Yes.
Okay, the next item is what?
Finance costs.
Okay, finance cost. The parent is
Finance cost, the parent is dash. And the subsidiary is having 2.
okay, so 2/2. Okay.
Yes.
The next one is what?
The next one is profit before taxation.
Okay, profits before taxation. Okay, so the next one after the profit before taxation is tax.
Yes.
Okay, the parent
In-
is how much?
It's income tax expense. The parent is 250.
Okay, the subsidiary is what?
The subsidiary is 9.
9/2. Okay, did they have any other issues there?
No.
Okay, so we have the profit for the year, but there will be a retranslation gain. So profit for the year. The profit for the year, then you now have the other comprehensive income items, which will be the translation on the goodwill and the net assets. So other comprehensive income item. Okay, so from this one, you just go to your statement of financial position. Okay, so you have your non-current assets. Then you have your PP. PP is the first one, isn't it?
Yes.
Okay. The parent is what?
The parent is 297 million.
297 million. Okay, the subsidiary, we use the rate at the date of the reporting. So let's go and determine the rate that was given to us before we even come to the footnotes. So what is the rate at what? 30th April 2x4.
2.5.
No, you have to be very careful with the dates. That is 2x3. The reporting date now is 2x4.
Okay.
Okay. So it's 2x4. So we use the rate at the 2x4, which is 30th April. That will be 2.1. Okay. So that will be 2.1. So the subsidiary figure is what?
The subsidiary is 146.
Okay, 146 divided by 2.1. Okay, the next item is what?
It's investment in random.
Okay, that is the investment in the subsidiary, which is going to cancel their equity items, and the difference will be the goodwill. So we don't bring it. The next one is what?
Loan to random.
Okay, the loan to random will be cancelled. That is intra-group what? Activity. But let's put it there and go and look at what is happening there. The value is what?
It's 5.
Okay, it's 5. The next one is what?
It's current assets.
So there might be a goodwill. So you write a goodwill there. If there's no goodwill, then you put dash. Current assets. The current asset is how much?
Current asset is 355 for the
355.
period.
Okay, and the subsidiary is
Subsidiary is 102.
102 divided by 2.1. Am I correct?
Yes.
Okay. So the next one will be equity and liabilities. Okay. So the equity will bring only the parents item. So what is the equity for the parents?
It's 60.
Okay. So we go to return earnings. The return earnings, that will be the group return earnings. We do workings for it. Okay. So what is the next equity item there?
It's non-controlling interest, NCI.
Okay. So group return earnings. And we now have the NCI. The NCI too, we do workings for it. So do we have any long-term liabilities there?
Yes.
Okay. So non-current liabilities. Okay. What are we having for it?
Non-current liabilities, like current liabilities is 205 for the parent and 60 for subsidiary.
The non-current one.
Yeah. Sorry, non-current liabilities is 30.
30 for the parents.
30 for the parent
Okay.
and 41 for the subsidiary.
Okay. 41 for the subsidiary. Okay. That particular one, there is a loan in that particular one. But if we come, I will come and show you how you can go about it. Okay. Let's now move on to the
current
current liabilities. Okay. The current liabilities is what?
205 plus 60 divided by 2.1.
Okay, 2.1. So we don't have any other issues again.
Yes.
Okay, let's now take the footnotes. And the next thing will be the workings. The workings, the first one is the group structure. We all know how to do the group structure, so we are not going to be having problem with that. So the group structure will be the first one. And the second will be the net asset. The net asset calculation is done in the calculation of goodwill is done in the currency of the subsidiary before we retranslate. So we have the net assets of the subsidiary, which will be the random. Then we have at acquisition and at reporting. So we have the currency here. We have the currency here. So let's now take the question and we now look at the net assets. Okay, so let's now read the top to know how much we are paying.
Okay, so I should read. Okay.
Senior
The
Deborah, are you there? Or Senior, you can read for us.
Okay.
Okay.
The following information is relevant to the preparation of the consolidated financial statement of memo. A. During
Okay.
the
So
financial year,
let's take the top. Memo acquired random on 1st April for consideration of what? 120 million crowns, isn't it? Okay.
yeah,
That will help us in the calculation of the goodwill. So goodwill calculation will be done in the foreign currency. So you have to, sometimes the question can give you the amount that the parent has paid. So you have to find the foreign currency equivalent at the date of what? Acquisition. So I will also show you how you can go about that one. So this one will be goodwill calculation. So the goodwill calculation will come here. So you have your purchase consideration. The purchase consideration will be 120. It will be done in the subsidiaries currency. Okay. And when their retained earnings of random were what? 80 million crowns. So we come to that one later. Look at the investment in random. How much is that one in the parent currency?
$48 million.
Okay. It means that the parent has already what? Translated this, isn't it? Okay.
Yes.
Go to, if you want to know, sometimes they will not give you the foreign currency of the purchase consideration. They will just give you the parent what equivalent, which is 48. But they will now ask yourself, what was the date of acquisition? The date of acquisition was what? 1st May, 2x3. And that date, the exchange rate was 2.5. So the question now is, we are dividing to get a parent one. So if you want to know the subsidiaries one, it means that you have to multiply. So you have 2.5 times 48. You'll be getting 120. And that is what they have given to you over there. So sometimes they will not give it to you. You have to find it for yourself. Okay. So let's now come to the equity capital of the subsidiary. The equity capital is 32. So that will help us to do the net assets. So the equity capital of the subsidiary will be 32. And it will be 32. So this one will be done in the subsidiary currency. Their retained earnings will be 80 against what? Reporting is how much? Reporting is 95.
Reporting is 75.
Okay. So 95. Reporting is 95. So 95. Okay, they have share premium, isn't it?
Yes.
Okay.
Yes.
If nothing is said about a share premium, you assume that the share premium is at acquisition. Okay. So since there was no issue of additional shares, share premium will always be at acquisition. The share premium is just like maybe they have issued shares above what? Its normal value. So the difference on the normal value, maybe the share is 2 cedis, but they have issued the shares at what? At 3 cedis. The 1 cedi is the premium. But since there is no issue of shares during the year, it means that there is no share premium after acquisition. The share premium will be at the date of acquisition. So the share premium, if nothing is said about it, it will always be at acquisition because the share premium will come in when shares are issued and the company has not issued any shares. So the share premium will be at acquisition. So you have the share premium at acquisition. So we have the share premium of 20, share premium of 20 and 20. If there's any fair value adjustment, you add. But if you are adding a fair value adjustment over here, you have to know that it will be depreciated. So you subtract the depreciation before you retranslate it using the closing rate. So maybe there can be a fair value adjustment of maybe 10 on a PPA that will be depreciating. So you have to depreciate it over here. You have to put the 10 over here. Then maybe the depreciation is 2. So it means that you'll be having a value of 8 before you translate the 8 using 2.1. The 8 will go to the statement of financial position. Then you translate it and send it there. Okay. But this one, I'm not sure that there's any fair value adjustment there. So let's come to I'm not sure that there's any fair value adjustment in this particular question. Okay. So there's no fair value adjustment over here. So we can find the net asset at acquisition and reporting. Then we move on. So net asset at acquisition is 132. Okay. At reporting is what? Sorry, there will be some issues with post-acquisition issues here. There can be a translation that will be resulting from profit or loss items. So you leave it until you are done with all the footnotes before you determine it. But this one, you can find the acquisition one. Always you have to find the acquisition one. The acquisition one, there will not be any other issues here. The issues over here will be the fair value adjustment. So you can have your net assets here. Your net asset at acquisition of 132. Okay, but we are going to be subtracting the NCI. So we go and look for how the NCI is being determined. So they have given us the NCI value already. That is the C. The fair value of the net asset of random at the date of acquisition is to be assumed to be the same as the current value. Momo uses the full goodwill method when accounting for acquisition of a subsidiary. Goodwill was impairment tested at the reporting date and have reduced in value by 10%. At the date of acquisition, the fair value of the non-controlling interest was 38. So let's go and calculate our goodwill. So this will be 38 over here. NCI will be 38. And this will give us 158. What will be the goodwill?
Genesis.
Okay. So the goodwill will be 26. But they say that the goodwill has impaired by what? The goodwill has impaired by 10%, isn't it? So impairment of goodwill over here will be 2.6. So the goodwill at reporting will be 23.4. This is what we'll be translating. But the impairment will go to where? Statement of profit or loss, because we are doing statement of profit or loss. So the impairment will be charged to this particular figure. So what you can do over here is that since it's a full year acquisition, you can come and add the impairment to this one, or you can do your over 2. Then you bring your impairment figure 2.6 over 2. Or you can add all of them, because since it's a full year, it means that the impairment will be added to the 20. But if it is a half year, then you first have to find your post-acquisition figure. That will be 6 times this one over 2 before you add the impairment value to it, because the impairment is purely for post-acquisition period. Okay, so you bring the impairment to distribution and administrative expenses. Let's now take the footnote, the 1. So we are done with the C. Then let's now take the 1. Let's now take the A. Okay, let's take the A.
Okay, A. During the financial year, Random has purchased raw materials from Memo and denominated the purchase in crowns in its financial record. The details of the transaction are set below. Date of transaction, raw materials was 1st February 2004, and the purchase price was 6 million. Profit percentage on selling price is 20%. At the end of the year, half of the raw materials purchased were still in the inventory of Random. The intercompany transaction have not been eliminated from the financial statement, and the goods were recorded by Random at the exchange rate ruling on 1st February 2004. So a payment of 6 million was made to Memo when the exchange rate was 2.2 crowns to $1. Any exchange gain or loss arising on the transaction is still held in the current liabilities of Random.
Okay. So let's deal with that issue. Okay. So who is selling? Who is selling over
Right.
here?
I think parent is selling.
Okay. So the purchase price is what?
The purchase price is $6 million.
Okay. That is the selling price, isn't it?
Yes,
Okay. What is the profit element on it?
20%.
So what will be the profit on the selling price?
Well, I think 1.2 million.
Okay. So what we do is that first of all, we have to eliminate the cell. There should not be any cell between them. So what you do is that you come to this place, you take the 6 million, you also take the 6 million over here. Then after that one, you find the provision for unrealized profit and come and add it to the cost of sales. Okay. So they are saying that half of these goods were what? Half of these goods were, half of the goods are still in inventory. So it means that the provision for unrealized profit will be what, 0.6. Am I correct? The provision for unrealized profit is it going to be 0.6?
Mhm.
Okay, let me show you how. It means that they have sold half and half is what's remaining there. So the provision for unrealized profits will be the 0.2 times the selling price of 6 million multiplied by the half of the goods that are yet to be sold. And that will give you 0.6 million. Okay, so that will be added to cost of sales and that will be taken from inventory. That will be taken from inventory. So we have 0.6. So that will be taken from the inventory. All right. Okay, let's look at this. Let's look at this and let's see what is going to be happening. So that is intra-group trading over there, but there will be some issues there. Okay, the intercompany transaction have not been eliminated from the financial statement and the goods were recorded by random at the exchange rate ruling on 1st February. So the goods were sold on 1st February. It means that they are still having it at the 1st February. Okay. Okay, it means that they are still having it at the 6 million there. There's no problem with that. Okay. A payment of 6 million.
The payment of 6 million was made
to Memo. When the exchange
to
rate,
Memo.
okay, when the
Rate was
exchange rate
2.
was what? 2.2, 2.21, isn't it?
Yes,
Okay. Let's now look at when was the goods sold?
the goods were sold on 1st February 2004.
Okay. So assuming they want to pay on that date, how much are they going to be paying to the parents? If the subsidiary want to pay on that particular date, the 1st February, the exchange rate was 2. Okay. So if they want to pay to the parents, they will be paying at the transaction date. So at the
They
transaction
will
date,
pay 12 million crowns.
okay, they will pay 12 million crowns, isn't it? So
Yeah,
at first February, they will be paying 6 times 2. That will give me 12 million crowns. Okay. But how much did they pay?
Was it a payment of 6 million was made to Memo when the exchange rate was 2.2 crowns to $1?
Okay, so that would be 2.2 times 6. So what was the payment made in crowns?
Was 13.2 million crowns.
So what is happening there?
Translation gain.
No, is a subsidiary who is paying. So the subsidiary will be having a loss. The parent
There's
will
a
still
loss.
be having 6 million. So the subsidiary will be
Exchange
having a
loss.
loss of what? Okay. So that particular loss is a loss that the subsidiary is going to be recognizing. Okay. It's a loss that the subsidiary is going to be recognizing. So any exchange gain or loss arising on a translation is still held in the current liabilities of what? Random. Okay. So any exchange gain or loss arising on the translation is still held in the current liabilities of what? Of ransom. Okay. The question now is the goods are on first a payment of 6 million was made to random when the exchange rate was 2.2 crowns to 1 million. Any exchange gain or loss arising on the transaction is still held in the current liabilities of random. Okay. The issue is they have paid. They have paid to these people, isn't it? They have paid to them. Okay, they have
Yes.
already paid for this one. So it means that the loss should not be in current liabilities, isn't it?
Yes.
So the time that they are paying, this is what they're supposed to do. This is what they're supposed to do. The time that they are paying, they should be debiting their profit or loss. They should be debiting their profit or loss, and they will be crediting what? Cash. That is what they're supposed to do. So since you are paying, they should be crediting cash and they should be debiting what? Profit or loss. But what are they debiting instead? What was debited instead?
Current liabilities.
They debited current liability instead of what? Debiting the profit or loss. So you are paying. Since you are paying, it means that the loss that you are going to be incurring, you are paying for that particular issue. So if you are paying, you should be debiting profit or loss and also debiting the current liability. But the current liability, you'll be debiting using the amount that you're supposed to pay them. So the difference over there, which is the loss, will go to profit or loss. But they are taking all the amount to what? To their current liabilities, instead of them taking portion to what? To profit or loss. So it means that the loss has not been taken to profit or loss in the first place. So they go there and take the loss of 1.2 over here, the loss over here, which is 1.2. They haven't done anything concerning it using no entries have been done for the profit or loss. So what you do is you count to the net asset over here. There will be a loss, which will be a post-acquisition item because that is after the acquisition. So this will be 1.2, and that has not been taken into consideration. So you also come to the loss over here, profit or loss. If you like, you can show it as a separate item. So you have your translation loss over here, or the translation. Then you have 1.2. Then let's be moving and see whether we are going to be having any other issues. But let's come to current liabilities. What is the effect of the loss on the current liabilities? It is going to be reducing their current liabilities, isn't it?
Yes.
So the current liabilities over here will be done like this: 60 plus 1.2 divided by what? 2.1. Are we correct? It means that the actual current liabilities will be 60 plus what? 1.2. because the loss was debited to the profit, to the current liability. So it means that they have reduced the actual current liabilities by 1.2, which is the loss. So let's now find the actual current liabilities now. Let's now find the actual current liabilities. Let's now find the actual current liabilities. So that is on that particular transaction. The sales is made by the parents. The sales is made by the parents. So what you are going to do is that you remove the sales, then you go and take your, you go and take your unrealized profit from that particular inventory over there. But the inventory over there, what you are going to do is that the inventory will be translated using the opening rate. So let's use the opening rate over there. It will be 6 times 2. That will be 12. I will come and tell you how you use 12, how you are going to deal with the 12 in the current asset there. Okay, the 12, how you are going to deal with the 12 in the current asset there. The current asset for them is 102. So the 102 over there, what you do is you are going to be taking that particular value from it, the 12 before you translate. But let's be moving, and let's see whether we can finish first. Okay. So we are done with that particular one. Okay, we are done with that particular one, and the payment of this one was made and the loss has been recognized. Let's come to the B.
So B.
Yeah.
B. Memo had made an interest-free loan to Random of $55 million on 1st May 2003. The loan was repaid on 30th May 2004. Random had included the loan in non-current liabilities and had recorded it at the exchange rate at 1st May 2003.
Okay, let's now, the loan has been repaid, but they haven't recognized that particular transaction. They haven't removed the repayment of the loan. So you can see that the loan has been repaid on the reporting date, but they haven't done that particular thing already. That is why they are saying that Random had included the loan in non-current liabilities and had recorded it at the exchange rate at what? 1st May 2x3. Okay. So let's now move on here. Let's now look at this particular value. What is going to be happening? So the time that the loan was given to them, what was the exchange rate? That was 1st May. So the loan will be 5 times 2.5. Would that be 12.5 crowns? The loan was given
Yeah.
to them at 1st May. That would be 2.5 crowns. So that would be 12.5 crowns. This is the amount that they have recognized the what? The loan. Okay. But at the reporting day, they have to pay the 5 million. The question now is how much in crowns on the reporting date are they going to be paying for the loan? How much in crowns on the reporting date are you going to be paying, because the loan was paid on the reporting date? So how much are they going to be paying? Would that be 2.1 times 5? On the reporting date, which is 31st May, 2x4, which is the same as the report. The loan will be paid the next day. So it means that it will still be having the same value over there. And that will be what? 2.5, 2.1 rather. It will be at the reporting date. They will retranslate the loan before the next day they will pay. And what will be the value of the 5 million in their currency, in their foreign currency? What will be the value of the 5 million? So let's look at this one. So we have the loan, May 20x3. The loan will be 5 multiplied by 2.5. That will be 12.5 crowns. But at the reporting date, which is April 2x4. They will now be paying 5, and this will now be paid at what, 2.1. That is the rate, the exchange rate at that particular date. What are we getting? I'm getting
10.5.
Okay. So what is going to happen? They will be having a gain, isn't it?
Yes.
A gain of 2 million. So that particular gain, they haven't recognized the gain yet, and the loan is still at that particular value. Okay. So what you do is you now come here, you come to the statement of profit or loss, the translation that we have, the net assets, then we now have a gain of 2 million at this particular place. But if you come to our retranslation gain over here, this will be negative. So what we do is that we bring the gain first. So we have 2 minus 1.2. Okay, so these two be divided by 2. Okay, that is what we are going to be getting. So we now come to the statement of financial position. The loan must be removed because this is intra-group loan. You can't give the loan to yourself. The loan must be what? Must be removed. But if you come here, what is the value of the loan? The loan was recognized at which value over here? The loan is included as what? 12.5, isn't it?
Yes.
Okay, so it means that included in the 41 over here, there is a loan of what? 12.5. So you take the 12.5 before you retranslate the remaining figure. Okay, so the 12.5, the loan is included at their spot rate, which is still the 12.5. But since we are removing the loan, it means that you have to come and take what? The 12.5 from the 41. Okay, before you translate the remaining figure there. Okay, so also you can decide to come and subtract the gain over here and still subtract the 10.5. Okay, so let's come to this particular figure, and okay, so let's look at another issue there, then we see what we can do. Okay, so that is all for this one. So what they are saying is that the random operates with a significant degree of autonomy in its business operation. They are just saying that their functional currency is the crown, because it's a way of you determine the functional currency of that particular company. Momo has paid a dividend of 8 million during the year. They haven't said that the dividend has not been recognized. Since it's Momo that is paying the dividend, it means that they have already recognized the dividends. Okay, I want to show something here, which will be the PP, the current asset over here. The current assets for these particular people. Okay, you can see that the 102 over here, okay, is including what? Inventory of what? This one is including the inventory of, what is the inventory value? What is the value of the inventory that a subsidiary is including there? The one that they have sold to them. Okay, the inventory was what? Okay, at the end of the year, raw materials purchase, we are still in the inventory of random. That is the half of the inventory. Okay, the intercompany transaction has not been eliminated from the financial statement of and the goods were recorded by these people at the exchange rate ruling on 1st February 2x4. On 1st February 2x4. Okay, so it means that the items are still at what? Their figure, which is 2x4. Okay, what we do is you can decide to remove that particular one from the subsidiary figure before you have those items, or you can just leave it and only take the parent figure over here. That is also okay. So let's have the 2.1 over here, then minus 0.6. There's no problem because this has been taken into consideration of the. So let's bring the goodwill here. The goodwill will be 23. Goodwill will be 23.4 divided by 2.1. Okay, so what are we going to do? Let's look at the profit or loss. Can we add the profit or loss? Maybe let's add some of them before we move on. So 142 divided by 2 minus 6 plus 200. The revenue I'm getting 265.
Yes, 265.
Okay. So what about the cost of sales?
Cost of sales. 162.
162.6.
Okay, we've added a 0.6.
Yeah.
Yes.
Okay, I'm having 102.4. That is a gross profit. Let's come to the translation gain over there. Okay, let's come to the translation over here. We are having a net gain of 0.8 divided by 2. So 0.8 divided by 2. I'm having 0.4. Okay.
Yes, 0.4.
Okay. The distribution expenses will be 20 plus 2.6 divided by 2 plus 30. So 22.6 divided by 2 plus 30. I'm getting 41.6, 41.3. Okay, the investment income. So let's come to operating expenses. So 102.4 plus 0.4 minus 41.3. I'm having 61.5. Okay, the investment income will be 4. Finance cost will be 1. Then we have plus 3. Then our profit before tax will be 64.5. Then we come to tax expense. The parent tax is what? 25 or 250?
Parent tax
Okay, it's 20.
is 20.
Okay. The parent tax is 20. So 29 divided by 2 plus 20. That will give us 24.5. So this will give us profit for the year is 40. So you just have to find the gain on the retranslation. So what is the gain over here? Let's come to this place. We have found this one already. Our net asset is 132. And what will be our net asset at reporting? Okay, so we can now, hey, this thing has finished. So we can now have NCA here. We can have NCA here. Okay, the NCA, you retranslate the NCI, which will be 38 divided by the rate at acquisition. The rate at acquisition. So you find the NCI value at acquisition, which will be the 38. The 38 divided by 2.5. So 38 divided by 2.5. 2.5. What are we getting?
15.2.
Okay, 15.2. So that is the NCI value at acquisition. Let's look at the post-acquisition profit. So 32 plus 95 plus 20 plus 0.8 minus 132. I'm having 15.8. Is that correct?
Yes,
Okay. That 15.8 will be translated using the average weight. So because it's profit, you translate it using the average weight. So 15.8 divided by 2.1. Okay, so you just share it among the NCI. So we have the share of profits, which will be 15.8 divided by 2.1 times 0.25. That will be for the NCI, 0.25. I'm getting 1.88. Is that correct? So the NCI will have their share of impairment. So the impairment was 2.6, which will be translated using the average weight divided by 2.1 times 0.25. So 2.6 divided by 2.1 times 0.25. That will be 0.31. Okay. So the group return earnings you have the share of the profit, you translate it using the average weight. You also translate the share of impairment using the average weight. Okay. Then you now, my board has gotten finished, so I cannot write again. So what we are going to show now is, let's show the gain on the translation gain on the goodwill. Okay, that is very important. How do we calculate it? You take your goodwill at acquisition. So at acquisition, what is a goodwill at acquisition? The goodwill that we have gotten, was 26 at acquisition. So that 26, if you want to translate it, that will be translated at acquisition date. That was what? 2.5. Acquisition date figure was 2.5. So that was 2.5. So we have 26 divided by 2.5. What are we getting? Hey, the average rate is 2. Hey, sorry, the average rate was 2. So this one's supposed to be, the average rate was 2. So this was supposed to be 2, 2. Okay, so 15.8 divided by 2 times 0.25, supposed to be 1.98. 1.98 or 1.975. Okay, 2.6 divided by 2. 2.6 divided by 2 times 0.25, supposed to be 0.325. That is the impairment, 0.325. Okay, let's now come to the goodwill. The goodwill at acquisition, what would be the CD, what would be the dollar equivalent? It will be 26 divided by 2.5. I'm getting 10.4. Okay, so there will be an impairment on the goodwill. The impairment is 2.6. That will be translated using average weight. So the impairment will reduce it. Then we have 2.6 divided by 2. That will be 1.3. So this will be minus 10.4. We are having 9.1. This is supposed to be the goodwill figure. But what is the goodwill in the, so that will be the reporting. We look at the reporting figure now. The goodwill will now be the 23.4. 23.4, which will be translated using 2.1, which is the reporting rate. So 23.4 divided by 2.1. I'm having 11.14. So 11.14. What is the difference? So 11.14 minus 9.1. Okay, that is 2.04. So the retranslation gain, the first one will give us 2.04, which is on the goodwill. Then we come and add the net asset to it. So if you go to statement of financial position, your goodwill will be translated using 11.14. That is okay. Then let's come to the net assets. So the net asset, the gain on the net asset, you always start with the acquisition figure. So what was their net asset at acquisition? So the net asset at acquisition was, we have done that calculation already. It was 132. Okay, that was 132 divided by the rate at acquisition, 2.5. So 132 divided by 2.5. 132 divided by 2.5. I'm getting 52.8. Okay, what will happen is the profit for the year. That will increase the net asset. What is the profit? The profit was 15.8. That will be translated using average rate. So 15.8 divided by 2. That will give us 7.9. So what is the total supposed net asset? 0.8. That will be 60.7. Then you will now come here and look at the net asset at reporting. The net asset at reporting will be 132 plus 15.8. That is 47.8. So you come and do your 47.8 over here, 147.8. That will be translated using the closing rate. So
Linus,
yeah,
still there plenty for my top.
it's plenty. It's plenty. So you just translate and move on. It will always be small, but it's plenty.
Wow.
It's very plenty. And that will be 70.38. So the difference will be, is the gain calculation that is plenty, it's plenty. And that will give us 9.68. So you come and share this gain to the parent and then the NCI because they're using the full goodwill method. So you just send your figures to statement of financial position. My board has finished. So this one, the translation, just translate and add. This will be dash. This one, you have done it already. So you translate this one too. This will be 60. So the NCI, you do the calculation. The group return is you do their calculation and bring it. This one too, you do the translation and put it there. That is all. It's plenty. It's plenty. All right.